The four most expensive words in the English language, this time it's different. Sir John Templeton, legendary investor, and he is exactly right. There is nothing new under the sun, as King Solomon said. And as we look at the markets today, we see that playing out. We warned you yesterday after the big drop that we didn't have a weekly vertical crossover occurring yet, so it was not a time to get in. And guess what happened over the course of today? That is Tuesday. We see the market rebounding up 0.90%. Now, that is not pulling back at all the weekly down candle that we have forming after the prior week's down candle. Price percent oscillator still moving toward the red signal line, and we may have a weekly vertical crossover by the end of the week. We may not. Things may bounce off that red signal line and head back up again. Derivative oscillators also losing energy. But my friends, again, it's never different. It's always the same. We see patterns repeat over and over and over. And what we do every day is study those patterns and get good at recognizing them, when they're working, when they're not working, and how to use them. And when you figure this out, my friends, you can have your own virtual printing press of money. How is that? You get in the market when it's going up. You get out of the market when it's going down. You get back in the market when it's going up. You get out of the market when it's going down. If you want to get more sophisticated, when it rotates over going down, you short the market. You go from something like SPY to an inverse of that fund, something like SH. And you can actually see it move up when the overall market is moving down, when the prime index that it tracks the inverse of. So that's the beautiful thing about ETFs. Investors haven't always had all of these options. We're so deluged by information. I was talking to one of our oldest Patreon members, Jay, today, about the market and about keeping it simple. And as Jay was saying, and I was agreeing, my friends, Occam's razor, keep things as simple as possible. And as Einstein said, but not simpler. That's why we use the simple price percent oscillator along with our derivative oscillator, with our Bollinger Bands, our simple trend lines, and our Heikin Ashi candlesticks. That's how simple we keep it. Why do we keep it that way? Because it works time and time and time again. Does it sometimes not work? Very occasionally, it doesn't work. But most of the time, the large percentage of it, if you follow the charts correctly as we teach in our book and here every single day, it works. 5 to 10 minutes, 10 to 15 minutes. We used to say 5 to 10, but maybe I've just gotten longer-winded. Maybe I have more to tell you every day, but is 10 to 15 minutes too much to ask? I hope not, because it's those 10 to 15 minutes of you concentrating on the market every day that will lead you to mastery. Let's jump into these charts. Now, we've already talked about the weekly chart on the S&P. We're going to see where that pullback occurred as we delve a little deeper. Two-day chart, of course, the prior complete two-day candle formed on Monday the 13th. That represented Friday and Monday. This latest candle is just the first day of the latest candle, and we can see the pullback right there. We can see that, yes, we do have a red down candle. The wick, however, is not nearly as long as the prior wick. Derivative oscillator still gaining downward momentum. Price percent oscillator pulled back a little bit on the angle it had been heading down, but still heading down quite strongly. Then we go to the 4-hour chart. That's where we see things bouncing off that red candle at the end of the day on Monday, up in the morning, up a little more in the afternoon, up 0.90%, so almost a percent. And we can see the derivative oscillator has lost a lot of energy. It's losing all that downward momentum. However, we look at the price percent oscillator. It started heading up in the morning and then sort of turned and is pushing down just a little bit toward the end of the day. Now, what's happening here potentially? Market might just be taking a breather from that huge slam down on Monday. And again, you know, what the market did a lot of was put the screws to the shorts. The people who said, oh, I know where this market's going, I'm going to get in. Well, That's what happens when you don't use your weekly vertical crossover. All the charts, all the time. But remember, the bigger the wave, the bigger the money. That's why, folks, we have weekly vertical crossovers that we count on. We'll see if we have one at the end of the week. Let's go to the Qs. Pretty much the same thing. The Qs actually was up even more, 1.10%. We look at the candles as we see them forming. The weekly chart is, of course, down. Price percent oscillator still going down strongly. Derivative oscillator losing upward momentum. Again, still in a confirmed up move on that weekly chart. Won't happen until the end of the week if it happens at all. We see the 2-day chart heading down. First day of this latest 2-day candle dropping off a little further. Price percent oscillator not heading down at the same angle it had been. It lost a little bit of that. Derivative oscillator gaining downward momentum. Same kind of pullback we see. And as we tune in to that shorter chart, we can see it there. We had a doji in the morning, lots of indecision tending up, and then up movement in the afternoon. Derivative oscillator losing downward momentum. Price percent oscillator still heading down. And again, keep an eye on things. Things are still below the 2-day trend line. Market might just be getting its legs, getting ready for another push down. We'll see. We'll just, again, we're not going to get panicked. We're not going to overly worry about this, make it complicated. Life's too short to sweat this stuff. We're just going to watch and see what the charts tell us. And when the charts tell us to buy, we're going to do our virtual trades or investments, if you want to call them that. When the market tells us to sell, we're going to sell. Let's jump into 20-year bonds. What do we see going on there? Well, bonds were down a little bit for the day after bumping up over the prior day. Bonds down 0.29%. However, we see the weekly candle still moving up in bonds. And we see the price percent oscillator pulling away from the red signal line. Derivative oscillators green so far, 2 days into a 5-day candle. First day of the latest 2-day chart, we see pushing up, but again, not going as high on the wick as it did the prior day. The big candle's a little bit higher. We see the price percent oscillator also losing some of its upward momentum. Derivative oscillator still gaining momentum. Price is above the 2-day trend line. Now we go to the 4-hour chart. What do we see there? That's where we see things peeling off, opening up with a red spin, or closing that morning with a red spinning top, first candle of the day. Second candle down, pushing down, and again, like we said, down 0.29%. Price is still above the 2-day trend line, well above the weekly. Of course, one thing we've been waiting on is for a pullback. Maybe we'll have that in bonds, and then if things cross back over going up, and the 2-day and the weekly are still moving in the same direction, you'll have a jumping in point. For those of you who want to know more about what we do here, let me tell you, spend 10 to 15 minutes with us every day listening to our daily reviews. You'll learn more as you listen and as you fill out your daily market worksheets. Those are available for free in the show notes. You want the show notes? How about subscribing at chartingwealth.com? We'll send you those show notes and the daily review every day it's put out, plus special trainings when they're put out. You'll see those in the show notes. Additionally, you'll get the weekly review, what we call the comprehensive review and forecast we put out on Friday afternoons after the close of the market. There's also a weekly market worksheet in those show notes and a trade worksheet. So when you do practice trades, you track them and you get all sorts of great information, learning possibilities from keeping up with all of those notes. So we encourage you to do that. Take 1 to 2 trainings a week. They're all available at chartingwealth.com for free. 1 to 2 of those, listen to them, take notes. You know, you all need a good little trader workbook where you keep your notes and such. And then, of course, buy the book. The book is everything compiled into a number of pages. We spent a lot of time on that book. It's spiral bound, so it's easy to have open on your desk and refer to it. We'd like to send you one. You can see a link in the show notes to purchase the book. If you happen to live overseas, for some reason Square will not clear foreign credit cards. However, if you will email us, cw@chartingwealth.com, we will provide you with an invoice from PayPal and send a book to you wherever you are in the world and receive mail. Lastly, go to our last chart. That is gold. What do we see there? Well, let's start. Remember, you always start with the biggest wave first. And gold, of course, has a big green up candle forming for this week. Derivative oscillator is heading up. Gold was down for the day 0.17%. Price percent oscillator heading up. Derivative oscillator losing downward momentum. And we go from the weekly to the 2-day. And of course, what we see there is 2-day chart crossed over last Thursday going up. After a prior up candle, there was enough momentum to cross the price percent oscillator over. And as our oscillators typically do, when the price percent oscillator crosses over at the same time of the derivative oscillator, usually that is a very good sign for continued movement, and it has been. We saw up movement on the 2-day candle ending on Monday. The first day of this latest 2-day candle is, of course, a weakening. Again, remember, Heikin-Ashi candlesticks represent average pace. They're not your typical high open, low close candlestick. So even though it was a down day, the average pace, based on the way the Heikin-Ashi candlestick measures it, is up. And I want you to understand that more. How? By taking the training. I'm going to put it at the end of the video. You'll see a link to it right now at the top of the page if you're watching the video. If you are simply listening to our popular podcast, then just go to chartingwealth.com, look up Heikin-Ashi. That's H-E-I-K-E-N, Heikin-Ashi, A-S-H-I. You'll find that training. About 113,000 the last time I checked people have taken that training. We want you to hear it. It'll help you. It'll convince you that Heikin-Ashi candlesticks are the best candlestick to use, the easiest to use, the most helpful. That's why we use them over and over and have for years. But it's showing us the average pace is still up on gold on the first day of this latest 2-day candle, even though gold was down. Now, this is on the 2-day chart. Of course, it pushed through the weekly trend line back on Thursday. And as we see things continuing to move up on gold, we go to the 4-hour, and that's where you see things blowing off the steam. We see that gold moved up strong in the morning on Monday and then topped off a little bit higher in the afternoon, but sideways and down a little bit on Tuesday. Price percent oscillator, however, still heading up. Derivative oscillator still positive, lost a little bit of energy. But again, keep your eye on gold. It may be that things have topped out. We'll just continue to watch and see. Remember, the biggest wave in gold is still in a confirmed down move. And all things being equal, the market tends to move in the direction of the largest chart, which still has not crossed over going up. So we'll see how gold continues to shake out with all of our other ETFs throughout the course of the week. You have questions, problems, concerns? Let us hear from you. Write us, cw@chartingwealth.com. Thanks so much for being with us, my friends. Stay positive, stay focused, and remember, there's nothing new under the sun. We just want to get good at creating our own printing press. And of course, we want to be ready for when that systemic market crash occurs. When everyone else is losing everything, we are going to be protected out of the market and looking to make money in strong down moves with inverse funds or perhaps gold or bonds, whatever might be going up. All the best. Take care from the whole team here at Charting Wealth World Headquarters.